The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Scorebox Europe. I'm Steve Sedgwick with Karen Cho and Ben Boulos, and these are your headlines. Enterprise software and private capital lead yet another AI-fueled sell-off on Wall Street. Investors weighing the impact of a new Anthropic programming language alongside a report predicting AI will lead to mass white-collar unemployment.
Standard Chartered posts a bottom-line miss for the fourth quarter, even amid a pickup in its wealth management business. The lender also announcing a $1.5 billion buyback. CEO Bill Winters gives his take on tariffs.
The uncertainty is a problem because it causes people to delay investment. So we obviously had a big spike down in the markets around the April tariff increases last year. And people quickly came to realize that there were, first of all, there was going to be some mitigation. But second, while investment patterns shifted.
US President Donald Trump warns countries against playing games as new global tariffs take effect at 10%, while the EU halts a vote on its US trade deal. We'll hear from the European Parliament's top trade delegate, Bernd Lange, later this hour.
Let's take stock of some of these market moves after a report released by Citrini Research over the weekend refueled the AI scare trade, with shares in companies such as American Express, DoorDash and more slipping in yesterday's trading session. The report presents a scenario in which AI helps users save money by vibe coding delivery apps and eliminating transaction fees from payment processors, with the technology leading to mass white-collar unemployment, declining consumer spending and economic contraction. A look at the markets, and don't forget the AI boom has been behind the big productivity drive that has been really fueling a lot of those market moves we've seen in recent months. So the very opposite scenario painted over the weekend, destroying some of that confidence yet again. We've seen bumpy trading sessions like that. And if you take a look at some of the moves lower, it was a fairly decent sized decline, 1.1 coming off the NASDAQ, more than 1% off the S&P 500, and the Dow also reversing 1.6%. But again, we have seen steeper falls than that before, and this is in the vein where already there has been some selling pressure in quarters of the market. Well, IBM posted its steepest daily fall in over 25 years yesterday, after Anthropic said that Claude Code could be used to modernize a programming language that runs on IBM systems. Shares dropped by over 13% following a blog post that said COBOL, which is used in banking, insurance and government systems, could be modernized in quarters rather than years, according to Anthropic. A look at some of the big AI plays, and you can see the impact here. Microsoft down 3% as well. The trades we're looking at too, and the payment providers from American Express to MasterCard, both down heavily 5 to 7%. And this is where we're seeing that pain trade. It's at stock-specific levels rather than the overall market indice level. I want to take you to the Asia markets, picking up on that trade from Wall Street. This is how Asia is faring in the trading session today. The Japanese stock market trading higher, along with the Kospi more contained as well, up a fairly firm 2% 0.8 in the green for the Shanghai Composite, but the Hong Kong market trading down 1.8%. To the European futures, and this is how Europe is now taking a stock of what we saw stateside. It is looking fairly even on the Stocks 50 futures, so we're still looking like we'll be banking higher territory. 0.2 firmer for the big chip stocks here in Europe. Flat for the FTSE futures, and the DAX looking to incline positive, Steve.
Credit ratings agency Moody's has warned that a gap in US accounting rules is creating loopholes that allow tech giants to conceal tens of billions of dollars in AI data center costs from their balance sheet. Wow, that is extraordinary, isn't it? Well, according to the ratings agency, disclosures may not show, quote, the full picture, and the accounting liability is unlikely to reflect certain plausible future scenarios. That is quite extraordinary. Does anyone else? I mean, I know we're going to move on, and we've got 1,000 stories to look at this morning, and I've already gone off piste. But my goodness me, Moody's has warned that gaps in US accounting rules creating loopholes to allow tech giants to conceal tens of billions of dollars in data center costs from their balance sheet. Meanwhile, a new analysis by Bridgewater Associates shows Alphabet, Amazon, Meta and Microsoft are expected to spend a combined $650 billion. Didn't we know that? Okay, $650 billion to bolster AI infrastructure this year. The expected spending would be around $240 billion higher than 2025's figure. Okay, so we've got Ben, Karen and myself here to suggest. I'll just say a couple of things. The job of the journalist in a bull market is to get beaten up. It's to get emails back from my wonderful correspondent saying, you're always bearish, you got it wrong, you were wrong on Bitcoin, you're wrong on Nvidia. And that's our job, because we're here to raise questions. But when the market has got its blinkers on and it can only see the finishing line, which is AI dominance or whatever it may well be, it is our job to raise questions and always keep probing, and to be fair, to be proven wrong in many cases, because the market is very rarely wrong at the moment in time anyway, and just still loves this stuff. At moments like now, it's a little bit more circumspect. Nicholas Taleb, comments were interesting. Citrini comments were interesting. The Moody's comments are interesting. The concern over SCOTUS rulings has added a different layer on, concern of what it means for the government finances, concerns about the confirmation process of Mr. Walsh and all the other things going on in the world, which include potentially two of the biggest aircraft carrier fleets in history converging on Iran as well. So there's lots of reasons why the market normally ignores stuff, but today, I would say yesterday, it certainly got a bit worried about more than one or two of these things.
It's all interconnected to the point around some of the big AI fears. At what price did you buy into a certain asset? Is the valuation stretch if funding costs are not going in the right direction? And could we see large-scale disruption to business models that we have seen now stretched to fairly extreme valuation? So it's all interconnected. To me, what is fascinating as we talk about testing the narrative out there, this Citrini research report talking about the disruption from AI as a big negative, some sort of downward spiral that we could be seeing. That is the real flip side of what we've been talking about for many, many months, that AI is going to be very good for economies, that's going to be very good for stock markets. So I think we're now seeing just an alternative view that, look, there are going to be some winners and a lot of losers. And I think that's what the market's reacting to.
Something that I've never understood, and I've tried to explain it as well I can on this channel, is something you just referred to. You said large-scale disruption. The whole point of AI is that it's going to create large-scale disruption. That is what we've been sold. That is the message that Karen and I, and you, I'm sure, your previous organisation, we've been sold that it's massive, massive disruption from the status quo. How can the people who are trying to sell that vision then tell us it's not going to cause massive disruption for all these companies? That it's actually just going to be net winner for everything. We're going to introduce the greatest bit of technology since fire was found by a Neolithic man or whoever it was as well. But it's not going to upset these companies. And that has never made sense to me.
And I think inevitably in something this revolutionary, you will get winners and you'll get losers. And I think what's emerging in my reading around it is that the winners are going to be those who harness the use of AI to lower their costs, to increase their margins, rather than the ones who risk becoming obsolete because their entire function becomes unnecessary. This talk around enterprise software and what it means. But then on the flip side of that, people say, can you imagine a world in which businesses are not using the established office suites that they use for word processing, for spreadsheets?
For sure.
But then people would have said the
concept.
same about typewriters and fax machines years ago, wouldn't they?
I don't know a lot of the terms, so I remind myself all the time. Vibe coding. Just to remind a few of you, I'm sure you two know all about vibe coding. I remember, I forget, I remember, I forget. I think a lot of us are like that. Vibe coding is AI-driven software development approach where developers use natural language prompts to guide LLMs to generate, refine, debug, often without writing it line by line, i.e. they're using the amazing stuff that's there, but not having to write new code for it. So vibe coding on top of what the others are doing is quite extraordinary. And I'll add in the fact that that's what, to a certain degree, the Chinese are once again being accused of.
So we've done a lot of work on this already before this has been in the headlines. We've been asking the questions around the potential of vibe coding to disrupt. And yes, so as a CEO, you could be looking at your own website and you could be vibe coding and say, change this font, change the backdrop, put in a section here that allows my client to do this. You can change the app, you can change the system using vibe coding as someone who has absolutely no technical experience whatsoever. However, there can be bugs, and this is where the experts come in. You may try and change your own interface, but you need to make sure it works, so you're not putting all of your clients at risk, all of your customers at risk. That's where the experts still come in and have to sort out whether there are some bugs. It's like, I mean, we can all use a computer, but when something goes wrong, who do we call? We call the IT person, because none of us have a clue. You still need that person. You still need someone who is fulfilling that function down the track. You can't be completely clueless without any backup.
But I think you need fewer of those people. And friends of mine who work in the coding space, they're programmers, they said that they've gone from a situation where they do the fun bit of the coding and the actual creation to then basically auditing the code that's been done by AI programs for them. And I think another potential big disruption on the horizon, it's not actually that far off a horizon. Later today, Anthropic hosting an enterprise briefing with new product announcements. This is after last Friday, they debuted a new security tool, which means that the software could scan code for vulnerabilities. What does this mean for the traditional software security firms?
Well, but on another level, the other headline, which we haven't even mentioned yet, is that Anthropic has accused 3 Chinese AI companies of illicitly extracting capabilities from its Claude chatbot. Industrial scale intellectual theft is what they call it. It's called distillation as well. Now, if the people who are trying to sell the services put out their product and the Chinese, or it could be someone else, but in this case, if it's accurate, the Chinese are then taking this, doing it, and then selling a similar product, but not using all that compute. What does that mean for the people who are spending all that money on the compute? And dare I say it, another thing we haven't even mentioned again, the private markets who are backing this, obviously with the Blue Owl story blowing up a little bit over the last 48 hours.
You're talking about the proprietary laws in an AI universe. Again, these are still early days in terms of how this all works. But I think the other point you raise around private capital is significant, because these are companies, these are vehicles that have gone and invested in software, they've invested in startups, they've invested in companies that are being disrupted even at an early phase. And that's why you were seeing, I think, large-scale concerns about the underwriting of some of these assets for the future.
And the question is, what happens when they have to start writing down some of those loans if some of them turn sour? That's the worry. Gosh, we could go on all programme like this, but we've got plenty more coming up, including the fact that Novo Nordisk shares slump as its weight loss drug fails to match a key rival in trial. We'll bring you Charlotte's conversation with the pharma giant's chief scientific officer. Plus, Ukraine marks 4 years since Russia's full-scale invasion as a peace deal remains elusive. And the tariff turmoil, it continues, with the European Parliament pressing pause on approving its trade deal with Washington. We'll speak to the body's top trade delegate later this hour. That is coming up at 7:45 London time.
I'm Steve Sedgwick from CNBC, and in my new podcast, Executive Decisions, I ask powerful leaders about their decisions that changed everything.
I'm not frightened of making tough decisions, and I think leadership can be very lonely.
Business leaders should not stay quiet in a world which is super complex.
It is absolutely fine to also change your mind.
Tough calls, personal crossroads. These are the stories that we can all learn from. It's Executive Decisions from CNBC. Get it wherever you get your podcasts.
AI jitters spread from the software sector to US private capital giants on Monday, hitting names which have extended loans to and hold equity in software companies. Shares in Ares, Apollo and Blackstone fell over 5%, while shares in KKR closed the day just under 9% lower.
Defaults amongst US corporate borrowers in the private credit market rose to 5.8% in the 12 months to January, according to data from Fitch Ratings. That marks the highest rate since August 2024, with 11 noted defaults in January alone, almost double the monthly average recorded in 2025. Let's get to Oliver Harman, who is co-founder of Searchlight Capital Partners. Oliver, lovely to see you. Look, we talked at the top of the hour many things that people are beginning to be cognizant of. And I hasten to add, not everything we mentioned is going to come to fruition. Citrini was a great piece of research, but a lot of it won't happen.
Yes.
Mr. Taleb absolutely talked about black swans. That's how he's made his name. And it's absolutely right. He should talk about some of the concerns out there as well. But in terms of what you see happening at this stage of the cycle, just typify it for us.
Well, I think, first of all, the markets, and which is what we live with every day in the public markets, right? They're constantly assessing risk. You know, that's ultimately their job, right? They're trying to assess the risk.
I don't think they are, Oliver. I think they only do that at periodic times as well.
Well, I think they're trying to assess the risk of the future cash flows and earnings that these various companies could generate, right? And sometimes they'll gravitate more to euphoria, and sometimes they'll gravitate more to fear. And I think we're definitely in a moment right now where we've seen these big swings from euphoria. The world is going to be amazingly automated and everything will flow, you know, through these AI systems and tools, and all this CapEx being spent will have excellent ROI, to fear, you know, is there really going to be a good return on all this capital that's being spent? And two, what does it actually mean if we start creating too many efficiencies and white collar jobs start disappearing through AI programs? So I do think we're in a moment where every day there's going to be a lot, for many months I think we're going to see a lot of market volatility as everyone is trying to figure out what will happen and how fast will it happen. And now you're right, the Citrini report, I don't know if I'm pronouncing that correct.
Yeah, I think you're spot on.
Painted a very dark picture. You probably have to attach a low probability to it. The question is, how low of a probability do you attach to it? It's very different if it's 1% or 10%, you know?
Yeah, look, and I'll go back to the market being a price discovery mechanism.
Yes.
And I think we're on the same page. It's almost like, to use option terms, it's like a straddle. 1 minute, as you say, euphoria, next minute, pessimism,
That's
both
right.
irrational. But it's the bit in the middle I like as well.
Yes.
And that's when the market does get its pricing right, when it kind of has this discovery period. And I actually welcome what we're seeing now as people are beginning to ask individual companies, individual sectors, can you make this work financially? And I really applaud this phase of the market.
I agree with you. It is interesting. Obviously, we're in the Searchlight, we're in the private equity markets. Yeah. So we have a slightly different, you know, we have the luxury that we're not being marked day to day on our portfolio, right? So we have the chance to think longer term.
Does that mean the exuberance lasts a bit longer? Because dare I say it, the valuations that we're seeing on some of the mega names that are desperate to come to market in 2026, and they seem to desperate to leapfrog each other as well, despite talking about...
You mean the IPO pipeline?
I mean the IPO pipeline. So I just wonder whether the private markets, because obviously the IPO is where it meets the public markets, whether actually the shoe has dropped in the private markets yet.
I think you're right. I mean, let's take a step back. You know, we haven't had a lot of exits in private equity over the last few years, and that's due to several factors. But the fundamental issue facing the private markets has been one of excess leverage at high interest costs, right? There were a lot of deals done 21 as we were coming out of COVID in that euphoria period. There were a lot of deals done at high valuations with very high leverage levels. And so that doesn't give you much flexibility when there's any downturn. Then what happened is interest rates started rising, and you're in a situation where you might own a business that's generating cash flow that you can reinvest for growth. All of a sudden, you've got higher interest expenses, which you have to meet, so you have less cash flow to invest in your growth. And you're stuck in businesses that you might have paid a big price for, and you can't change it because you have that much of borrowing, and the interest expense is eating up your cash flow, so you're not growing as much as you'd hoped. And that's what we used to call, I think jokingly last time I was on, zombie companies. And I think, you know, there was a moment of euphoria where a lot of very large software, especially enterprise and software deals, were done at these very big multiples, you know.
Indeed they were. We remember what it was like post-COVID.
Yes.
Some of those connecting softwares, Teams for instance, or the calls that people were placing, the remote working that software was facilitating. But now it feels as though the Achilles heel for private equity and for private capital is the software market. What was so great about it, and I think we've probably spoken to thousands of these software companies over the years, is that they had the recurring revenues, very high margins, and customers that were so reliant on the product. Does any of that change in coming years?
I got to tell you, this is fascinating because we're living in such an interesting world right now, okay? We have at Searchlight, we got on this AI trend kind of early, and we hired our own in-house kind of data analytics AI expert team, and we have this in-house innovation team. You know, especially a lot of our younger professionals, they're part of this, you know, with the actual AI professionals that we have. And I was sitting yesterday, we sometimes after investment committee every Monday, we carve out half an hour to see what those guys are doing. Yesterday, I was sitting there, and a couple of our young folks took a software called Replit, which is something that creates vibe coding, which is what you're talking about. And they actually were able to replicate the functionality of a CRM system, which we've paid a lot of money for, and that a company that created that CRM system for us is, I'm sure, highly valued, because they always chuckled, well, once you have our CRM system, you'll never switch, and you have to pay us, monthly fees. Now, these young folks who are financially trained, business graduates, recreated a functionality of our CRM system. It took them maybe an hour. And the fascinating thing is they were able to customize it in a way that actually met our needs better than the CRM stuff. And you're thinking, this is unimaginable. If you're a shareholder in one of these software companies, you would have attached a 1% probability in your scenario cases that you could actually get. Absolutely, there would be a substitution of what you do so rapidly.
So, Oliver, the companies that we've been asking questions
so
of.
I learned this yesterday, so I'm fresh. It was an eye-opening moment for me.
Well, you've had to move quickly and think about business plans when you see them being disrupted. And the pushback we've had from companies that we've interviewed, and we've said this is possible. They say to us, well, what about the data management? I mean, you want to make sure your data is secure. Would you trust a system like that? You need to work across the organization. This is just one particular service that you can plug data into. I mean, aren't there still obstacles to replacing all of your software? There are always
obstacles, absolutely. There will definitely be obstacles, but let's not forget, the market always looks forward, right? So the market's thinking, sure, there's obstacles, but they'll figure out a way, because there'll be a clever cybersecurity company that allows you to build walls around it. And in 2-3 years, some of those could be manageable. So the question is, are those obstacles structural, or are they ones that you can manage? And I think people are just very concerned that these obstacles, it's not going to happen overnight. We're not chucking out our CRM like tomorrow. I didn't immediately call our CIO and say, we're done. But we are saying, wow, you know what? This is going to fundamentally allow us to work more efficiently. And our team feels ownership of this information. And now the interesting thing is, we'll obviously have to bring in a cyber firm on the security side and make sure it's all safe. But maybe in the next 12 months we'll actually do this. It's not tomorrow, but in the next 12 months. So it's really, really fascinating. I'm learning, and one of the funnest things as you get older is if you keep learning, kind of keeps you young. And we're in a moment right now where I'm learning every day, and it's fascinating. We're living in a really fascinating time.
I speak to all these CEOs. Ben's going to come in, but curiosity. If you don't, and a lot of the CEOs I speak to, on this podcast, if they don't remain curious, they just don't enjoy their jobs, and they're not good at their jobs.
To your point about
curiosity is important.
Yeah, I think so.
I think we're all learning as we go along with this. When you talk about the security, I was mentioning before about how Anthropic is rolling out a new tool that, as part of Claude, will allow it to search for vulnerabilities in other AI applications. So the cybersecurity firm that you may have been using now potentially also faces that same challenge. But I'm just intrigued as to your company has obviously seen a way of reducing the costs involved in the CRM software through the way you've described. The winners out of all of this disruption will be other companies that harness AI to reduce their costs and increase their margins. Where do you see that happening? Which are the ones that you think are using it to their benefit?
Well, first of all, you mentioned Anthropic. Last week when I was on the same innovation call, where yesterday I learned about Replit, last week we had some of our young people in this sort of innovation team take one of our, we build a lot of detailed financial models to model the, companies that we might be looking to value, what's their future cash flows, and we go into a lot of details. What are the revenue lines, what are the different operating costs? You run different scenarios, and we have a whole team of people who put together these financial models. Last Monday, we had some of our young guys do a demo where they fed a lot of data in a company that we're looking at into Claude, the latest version of Anthropic's Claude software, and asked it to build an Excel spreadsheet saying, these are the revenue lines I'm interested in. Can you look at all the historical data? These are some of the projections I'd like. These are different cost drivers I'd like you to look at. And they'd created a financial model for us within 20 minutes. Then it used the same software to correct errors and, are we doing tax right? Are we doing this right and that right? To create a model that actually replicated that work that some of our young, financial analysts are doing. So I think you're right, the automation is going forward and forward and forward.
Does that not worry you though? Because that sounds like one small step away from putting into it, design me an optimized portfolio.
Yes. Absolutely, absolutely. I think that's definitely something where we're headed, especially on the end of the investment market that's more automated, quant-driven. You know, I think in private equity, where you're ultimately still driving businesses, you're acquiring them with a vision for change, you know, with a vision for how do we run this company differently, how do we pull in all the management tools and all the resources to help affect change. You're a bit more insulated from that because that still requires a lot of judgment. And ultimately, at this point in time, human judgment and, to Steve's point, curiosity are still massively differentiators. So you definitely want to, in the investment world, try to live in that world. You know, we're matching curiosity and judgment as opposed to in one where you're just crunching massive amounts of data.
Curiosity, judgment, and trust was the thing that Kathy Clay from S&P
Market
said to us, that actually trust, that is one of the crucial barriers.
And you'll be pleased to know, I've just done a quick search on who your CRM provider is, and it hasn't come up yet. So I still don't know whether it's Salesforce.
I don't want to name any specific companies.
No, I know you don't, but I thought I'd have a look anyway to see whether the World Wide Web told us, and it hasn't yet.
We'll do that off camera.
But to answer your other question, which is, you know, which was how do you think about how some of the winners are? So that was also kind of what you were asking me. I mean, we started pivoting our portfolio already 3 years ago. More, you know, we invest a lot in services, and we kind of pivoted from, you know, the white collar driven, information-based, knowledge-based sectors, which were very attractive because they had high margins, good growth, good return on capital, increasing valuations. We sold out of a lot of them, and we started moving into more kind of blue-collar service-driven sectors that are doing repair, maintenance of large, often, actually we've been kind of focused also on infrastructure because we felt like these are things that aren't going to be displaced with AI. You might be able to run those companies slightly more efficiently because you can improve your processes, you can do a lot, gather more information more effectively to get whatever environmental permitting, whatever else you need to do. But they're actually, and they used to be a bit more out of favor because, you know, you had to manage larger workforces, they had slightly lower margins. Now they're actually coming back into favor because people are saying, well, they're still going to be busy because you still need to send the physical person out there to go and do the work.
Yeah, until the robots are deployed down the track. When the robots get going from those factories, then maybe that's a different story. Oliver, thank you so much for joining us. Oliver Harman with us, founding partner, Searchlight Capital Partners. Elsewhere, Panama has transferred interim operations of several ports to European shipping firms Maersk and MSC after annulling contracts held by Panama Port Company, a subsidiary of Hong Kong-based CK Hutchison. The annulment formalizes a Supreme Court ruling last month, which deemed concessions held by the PPC for the terminals as unconstitutional. Well, shares of Novo Nordisk tumbled more than 16% yesterday after the Danish pharma giant said trial results showed its next-generation weight loss drug did not match rival Eli Lilly's. Well, Charlotte joins us with plenty more on this. Charlotte, just walk us through the latest developments here, because I know the stock moved fairly aggressively on hopes that it might have had the jump on Eli Lilly.
Yes, certainly reigniting some of the fears from investors on the pipeline for Novo Nordisk there. There was the late trial in their experimental weight loss drug, CagriSema. They're not meeting basically its primary goal in this trial there with a weight loss that was lower than competitor Eli Lilly's Zepbound. So the weight loss was 23% after 84 weeks compared to 25.5 for Lilly's Zepbound. So I had a chance to catch up with the Chief Scientific Officer of Novo Nordisk, Dr. Lange, and we discussed the results of the trial.
The study showed a 23% weight loss with CagriSema, which is in line with what we've seen in previous studies. And the comparator drug showed a 25% weight loss. So the primary endpoint of showing non-inferiority was not met, but I think in this space of an open label trial, we are really satisfied with the 23% weight loss and maybe a little bit surprised by the 25% weight loss that we saw with the in-market drug.
So can I ask you, because there are a lot of questions on the fact that it was an open label design for that trial, and it means that participants knew which drugs they were taking, therefore opening the door to potential bias. So why was this decision made?
When the study was initiated 3-4 years ago, it was not possible for technical reasons to blind the study. We therefore decided to do the open label version. That's not optimal. As you say, when you do open label trials, you introduce the risk of bias, in particular when comparing an investigational drug with an in-market drug. Obviously, the investigators, potentially also some of the patients through media, have a lot of familiarity with the in-market drug, and therefore you do risk to see some as we saw today, some slightly surprising results. Surprising not so much for the investigational drug, maybe more for the in-market drug.
Now, Novo Nordisk said they are still optimistic about CagriSema. There are some additional trials with higher dose combinations there as well, so they're waiting to see the results on that. But certainly that has reinforced some of the fears around the pipeline for the companies try to regain the lead on this. Of course, they had a first mover advantage when they launched their obesity drug. Of course, there's more competition now with Eli Lilly Zepbound. There are some compounded drugs as well. So they hope that the launch of the pill will give them a bit of an edge again. They launched in January. They say it was a great launch there as well. But again, we saw some copies launching on the market. You remember the saga around Hims and Hers launching this before it was swiftly removed. But they are facing, they try to regain the lead on this market, and they gave this lower guidance for this year. They see the sales lower, down between 5 and 13% there. Well, they try to build the volume, and that's why they try to build the pipeline for the future. But what we see this morning, off the back of these disappointing trials, that we see several downgrades. JP Morgan, Nordea, Kepler Cheuvreux, Deutsche Bank, all cutting to hold from buy off the back of these results.